All right, we are taking a look at the price of oil, down a little bit today. Israel removing some troops from Gaza seems to be a consideration amongst investors because geopolitical concerns recently have been one of the drivers behind crude. But the price story since the start of the year, you can see on the chart, going from around 70 north of 85. Let's get some perspective on where energy goes from here. Eric Nuttall joining us, partner and portfolio manager at 9 Point Partners. Eric, nice to see you.
Good to be here.
I guess when you're trying to break down the considerations on the price of oil right now, I said geopolitics, always one consideration. How would you break down what have been the drivers behind crude?
Yeah, I think consensus is waking up to something that we've been talking about for several months, and that is the market is fundamentally tight. It's tight because demand has been exceeding the expectations of those who were bearish, worried about a slowdown in the U.S. economy, China, et cetera, not taking into account the pressures on supply growth this year, namely in U.S. shale, and the effectiveness of the cut on the part of Saudi Arabia and OPEC+. And so what we saw was when we were visiting January, February, oil was in the 70s. We thought we would hit at $80 oil price by the summertime. That's really when demand seasonally inflects. We'd have meaningful draws. I think the market is just a little ahead of itself by a couple of months. So it's really been a fundamental move supported by a few dollar premium due to what's been going on in the Middle East and Israel, Gaza, et cetera. So I don't think there's a meaningful political risk premium. I do think there is a couple dollars, $2 to $3 in the oil price now. But we remain bullish in the outlook for oil. We're not calling for $100 oil. It's becoming a little too topical right now. There's a bit of a euphoria, I think, in the energy market right now. So for those who call me a perma bull, this is not accurate. I do think we're a little overheated by a couple dollars, by a couple of months. We still are very, very constructive with the outlook going forward, given demand longer and stronger. The OPEC cut, taking down inventories. We typically have built between January and now by 100 million barrels. Last year, we've only built by about 78 million barrels. So the market very clearly is tight. Inventories we see heading to multi-year lows this summertime. So there's a strong underpinning for oil, but people are a little too euphoric at the moment.
Well, for WTI, what pricing would you be working off of, your sort of best guess going forward?
So coming into the year, we thought is 70 to 80-ish band, 70 being just a very firm floor that would be defended. 80-ish at a point, so that's about 80, call it 84, 85 Brent, where the pressure on OPEC Plus, the ability of OPEC Plus to start bringing those curtailed volumes back onto the market, we think that that's likely, especially this is an election year. I think Saudi is showing that they're practicing a Saudi first mentality, but there is, I think, a sensitivity to not wanting $100 oil when there's an election later in this fall time. So it's going to be this balancing act, oil being stable enough, taking out the volatility, allowing Saudi and others to bring on those volumes, allowing the market to absorb it. And that's when, if we meet a year from now, I think the narrative is going to be very different. We're going to be talking about the exhaustion of OPEC spare capacity, the end of meaningful growth out of U.S. shale, another year of very strong demand growth, inventories already at record low levels, heading lower. And at that point, we have to get to a discussion about, well, how high does oil have to go to rationalize demand? That's a very different conversation than today. Between now and then, we do have to absorb the barrels that have been taken off the market voluntarily by OPEC.
But that is a consideration it's because it is a tightly controlled market, in terms of ensuring that there is enough supply, but also what to do when, at the other end is a consideration as well.
Absolutely. And the theme of underinvestment remains. So there was a survey done by Raymond James out this morning. And directionally speaking, U.S.-directed capital expenditures were up like 40% 2 years ago. We're up 23% last year. This year, down 8%. And so it speaks to the challenges. We're too commonly focused on the few areas in the world that are growing when most areas in the world are actually in production decline.
And so I guess at the end of the day, for the all the headlines we hear about the economy and whether we get interest rates or cuts or not, you have heard resilience. Certainly in the United States, maybe less so in Canada, but to a certain extent. Does the fact that the economy just didn't collapse the way some had predicted, is that another consideration for oil prices?
For sure, because why were people so bearish for the past, or most people so bearish for the past year and a half? Most of it revolved around where we're going to have a soft landing, hard landing in China. We're seeing stagnation there. Europe was in mild recession. United States, of course, everybody was calling for a recession, the most considerable oil consumer. And so I think as people see that whenever the Fed starts to ease, you start to take the recessionary risks off the table. that's very clearly a positive indicator for future demand.
Okay. What about for Canada within this conversation? Actually spoke to the head of RBC recently, and he felt like the messaging on our renewable future, that sometimes when the messaging is not clear, that makes it challenging to prepare. But at the same time, what would you say about our energy sector itself and how it has been preparing for a greener future?
Sure.
At a time when there is still, all the numbers you're giving us tell us about a global economy that relies on natural resources.
I think there's a growing realization that the developed world is the driver of the future demand growth for oil. And so while it's very common for us in the West to be speaking about a transition, the focus of the majority of the world is on energy affordability and energy accessibility. There's almost negligible impact or focus on emissions. So the Indias, the Chinas of the world, they're trying to bring their 2.4 billion people, including Africans, 2.4 billion people on this planet don't have access to clean cooking fuel. So they're burning cow dung and wood in their homes to cook their food. Their focus is not on emissions reduction. And so we've got to be pragmatic. This supposed transition that we're on is measured in many, many, many decades. It's not years or quarters. And so the short-sightedness of our policymakers, including in Canada, we're setting ourselves up for a supply crisis in the years ahead if we're not just a little more practical about the realistic timeline of the supposed transition. In the history of humanity, it's always been about growing energy demand, and we need an all-of-the-above solution. If we're so stupid as to impact the investment in oil demand growth, we're going to have a supply shock crisis that'll impact the global economy.
All right.